Most people believe financial crises are accidents. They imagine bad decisions, greedy bankers, unlucky timing, or unpredictable market forces colliding into chaos. They're told crashes are failures, moments when the system breaks down and must be repaired. But what if crises are not breakdowns at all? What if they are moments when the system reveals its true design? Because throughout history, every major financial collapse has followed the same pattern. Wealth concentrates, power centralizes, rules change, and those who already control money emerge stronger than before. The crisis is never the end of the system. It is the moment the system resets in favor of those who understand it best. To understand this, we need to stop looking at crashes as isolated disasters and start seeing them as mechanisms of control. Long before modern markets, long before stock exchanges or central banks, societies already understood something essential. Fear changes behavior faster than force. And nothing generates fear like economic collapse. In early civilizations, debt crises were common, harvests failed, obligations couldn't be met, farmers defaulted, families lost land. And in response, rulers didn't abolish debt, they reorganized it. Debt jubilees were declared not out of mercy, but out of necessity. Too much collapse threatened social order. So kings reset the system just enough to keep control intact. The pattern was established early. Allow pressure to build, let collapse occur, then intervene, not to dismantle power, but to preserve it. As money systems evolved, this logic never disappeared. It became more sophisticated. By the time empires began issuing large-scale debt, financial collapse was no longer just a risk, it became a tool. The Roman Empire understood this well. As expansion slowed and military costs rose, the empire turned increasingly to debasement. Coins were diluted, trust eroded, prices rose. The population felt poorer even when the numbers looked the same. Collapse followed, not suddenly, but slowly. And as Rome weakened, power shifted away from public institutions toward private landowners and military elites. The state fractured, but control did not disappear. It simply changed hands. This was an early lesson the modern world would learn again and again. When systems collapse, they don't vanish. They consolidate. Fast forward to early modern Europe, and financial crises became more frequent and more strategic. As banks emerged and governments began borrowing heavily to fund wars, collapse became intertwined with state power. Monarchs defaulted. Banks failed. Entire economies froze. But each crisis left behind something new. Permanent taxation systems. Standing armies, centralized treasuries. Stronger financial institutions tied directly to political authority. The crisis was the justification. When England faced repeated debt emergencies in the 17th century, the solution wasn't less borrowing. It was institutionalization. The Bank of England was created not to prevent crises, but to manage them, to ensure the state could always access credit. From that moment on, collapse and control became inseparable. By the 19th century, industrial capitalism intensified the cycle. Railroads collapsed, banks failed. Markets panicked. Workers lost jobs. Savings vanished. And every time, governments stepped in, not to dismantle the financial elite, but to stabilize it. This created a powerful moral shift. Markets were allowed to take risks, but society absorbed the consequences. This logic reached a turning point in the early 20th century. World War I shattered global finance. Gold flows froze. Governments printed money. Debt exploded. When the war ended, economies were fragile, unequal, and deeply unstable. The Great Depression that followed was not just a market failure. It was a systemic reckoning. Banks collapsed. Credit vanished. Unemployment soared. Entire populations lost faith in money itself. But watch closely what happened next. Governments didn't eliminate banks. They didn't cancel debt. They didn't dismantle financial power. Instead, they centralized it. Central banks expanded authority. Regulation increased, but selectively. New monetary tools were introduced. And the public was told these changes were necessary to prevent future crises. The collapse justified control. This was the birth of modern financial management, not as a neutral system, but as a framework where crises legitimized intervention, surveillance, and restructuring. After World War II, the pattern hardened. The Bretton Woods system was created to stabilize global finance. Currencies were tied to the dollar. The dollar was tied to gold. And institutions like the IMF and World Bank were established to manage international crises. But these institutions didn't eliminate collapse, they managed it. When countries faced debt crises, assistance came with conditions. Austerity, privatization, structural reforms. Domestic control shifted outward. Crises became opportunities to reshape entire economies from the outside. By the late 20th century, the system had matured. Financial markets expanded faster than regulation. Derivatives multiplied. Leverage increased. Risk was hidden behind complexity. And then, in 2008, the illusion finally cracked. The global financial system didn't collapse because of ignorance. It collapsed because of incentives. Banks had grown too interconnected to fail. Risk had been distributed so widely that no one could trace it. Shadow banking had quietly grown larger than traditional banking. When housing prices fell, the system didn't absorb the shock. It amplified it. The response was revealing. Trillions were created overnight. Central banks expanded balance sheets at unprecedented speed. Interest rates dropped to zero, then below. But ordinary people were told recovery would take time. Once again, collapse didn't destroy power. It concentrated it. Large banks survived. Smaller institutions disappeared. Wealth inequality exploded. Asset prices soared, benefiting those who already owned assets. Crisis became a wealth transfer. And crucially, a new precedent was set. Central banks could intervene in any market, at any scale, at any time. From that moment forward, the line between emergency and normal policy disappeared. Crises no longer needed to be dramatic. They only needed to be declared. This changed how control worked. Financial stability became a justification for constant monitoring, stress tests, liquidity requirements, surveillance of capital flows. Risk was no longer something markets managed. It was something authorities defined. And then came a new kind of crisis. Not a market crash. Not a banking failure, but a global shutdown. The response was immediate. Money creation surpassed even 2008. Governments borrowed without restraint. Central banks absorbed the debt. Markets didn't crash, they soared. This revealed something critical. Modern financial systems no longer respond to reality. They respond to liquidity. Collapse no longer happens when systems fail. It happens when liquidity is withdrawn. This is the true lever of control. Who controls liquidity controls survival. In this environment, crisis doesn't need to be economic. It can be political, environmental, health-related, geopolitical. Any disruption can justify intervention. And every intervention leaves behind new infrastructure, more centralized, more opaque, more powerful. But here's the paradox. The more control is applied, the more fragile the system becomes. Because stability built on intervention requires constant support. Markets forget how to price risk. Debt loses meaning. Asset bubbles inflate quietly. And when collapse eventually comes, it comes faster and deeper. This is where modern financial control reveals its final form. Crises are no longer resolved. They are postponed. Debt is rolled forward. Losses are absorbed by balance sheets too large to understand. And trust shifts away from markets toward institutions. This creates a world where failure is socialized, but control is privatized. Where money exists not as a medium of exchange, but as a policy tool. Where collapse becomes a narrative used to justify expansion of authority. And most people never see it. They see inflation, but not liquidity. They feel instability, but not structure. They experience control, but not its mechanisms. This brings us to the deeper truth of financial crises. They are not anomalies. They are not mistakes. They are not purely failures. They are transitions. Moments when systems shed old limits and adopt new ones. And every transition tightens the link between money and power. Today, we live in a world permanently positioned on the edge of crisis. Markets move faster than economies. Debt grows faster than income. Financial instruments outnumber real assets. And control increasingly depends not on laws, but on access. Access to liquidity. Access to payment systems. Access to financial infrastructure. The future of financial control will not look like repression. It will look like stability. And that is the most dangerous form of all. Because when control feels like safety, resistance disappears. So the question is no longer whether the next crisis will come. It is who will be ready when it does. Who understands that collapse is not the end of the system, but the moment it reshapes itself. Who knows that every crisis leaves behind new rules, new hierarchies, and new winners. And who realizes that money is not collapsing, it is evolving. In the next episode, we will examine how crises stop being accidental and start becoming strategic, how instability itself becomes a governing tool, and why the system increasingly depends on controlled chaos to survive. If you want to understand how power moves through money, debt, and crisis, and where it's heading next, stay with the dark economy. Because the most important financial events are never announced. They are managed.